inject volatility, to induce liquidity, which is what we're seeing an example of here. This induction of liquidity, okay, is a, a result of a stop run, okay, that is clearly framed and repeats all the time. Now, this is how they run buy stops on shorts, to take those individuals out of the marketplace and accumulate new shorts. Now, they were sellers here clearly because the market had dropped. That's how we identify the fact that they did it. This was their footprint. Okay, so and up in here we have a footprint of the elephant. Okay, the elephant being smart money, that big entity in the marketplace that lumbers through and just cleans house and makes the majority of the money. So with that footprint in the marketplace, now what we do as a sniper, we want to see a revisit of that same activity, because our understanding is what? The sheer vastness of their orders clearly indicates that they are most likely not going to be able to get all of their intended or expected position on the initial time it trades to that price level. Okay, so in other words, we're assuming that we'll just say that 171.40 is a fair assessment for an average price for them. Okay, and without breaking all this down in here and including this over here, which we'll do at a later time in mitigation, volume 5, we'll look at refining greater what institutional pricing is and where they do their dirty work for actual entries and exits. But for now, I want you to understand the framework of what constitutes a high odds order block. The bullish candle prior to the downswing in price is where they sold into that rally here. They sold into that. Much in the same capacity they sold into this bullish candle. All this action up here is what they sold into, running out an old high here. See that? Now, when we see this price leg here, that's the price action that we anticipate. Then you're going to see an impulse leg moving into the range that's defined by the high here and the low here. So when prices starts to move higher, okay, we want to ideally see some sort of minor retracement against that impulse move, okay, and create a short-term high. All we need is a high with two lower highs, one on each side of the high. Okay, that's a short-term high. Once that occurs, we know in our mind that above this high is going to be buy stops, because folks are going to see this down move here, and this is going to be viewed as a retracement and then short. That's how they're going to anticipate that. Okay, and because a lot of retail traders use 50% retracement levels, okay, let's look at this. The high down to the low. Okay, here's the 50% retracement level right there, and when you know it, there's where the swing high forms. Okay, and then it starts to roll over a little bit in here. That's what we're looking for. That is the absolute wonderful confirmation that what we're about to see is carnage on the retail world. Okay, and they're going to blow out the stops here at midnight. We are not interested in this down move here. We don't have any interest in that whatsoever. We could care less about that. We're more inclined to sell if it gets back to this order block after 5 GMT, or what would be viewed as midnight in New York time. So in other words, wherever you live in the world, okay, if you want to view the market like ICT, okay, the way I interpret the marketplace is you have to know what time midnight is in New York. You have to, okay, otherwise you're not going to see what I see, okay, and what I anticipate in the marketplace. So we have two primary focal points: is a price level of 171.36 minimum threshold. It has to trade to that level minimum, and it has to do it after midnight New York time, or 5 GMT in my platform here. And by doing that, okay, what we've done is we have our scope of like a rifle on a sniper's rifle. Okay, that's where we're going to be doing our shorts. If now here's the big payoff for you. It has to have a run of stops here. Okay, so if we blow out stops, as indicated with this little short-term high here, as soon as we gun stops here, which we see it here happening, okay, we know that it's going to fuel the rally up into this order block propelling them into an area where they could do more selling. And look at the immediate response there. It trades up into that range of this previous order block, and then boom, slams, runs away the other way. Okay, you see that? That is a high odds bearish order block. Okay, and true day down here calling it, hold, 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 and then you see a profitable result as it is indicated in the charts here. Okay, we have a big run on stops here. Okay, and again, we're going to talk about this whole price structure because it's not in the scope of what we're teaching here, but it will be dealt with in volume 5. So we're building an understanding, a greater understanding of what it is that you are hopefully trying to digest when you look at price action. Who's doing what at what time. Okay, we have, again, we have 5 GMT or midnight time frame, okay, in New York. We have an area where we see stops being right here. This is a short-term high inside of the range here. See, this just dropped down here. Now, why am I not talking about this? Because this is a climax reversal, okay? And climax reversals rarely see a return back to the high, okay? And again, this will all be talked about in great detail in the mitigation volume. So we have stops, known stops that will be right above this high, okay? And a run up. See that run up here? This little drive higher. Where's the order block that it's reaching for? Here's the bottom of the bullish candle. See that? Right in here. So between time, which is defined by 12 midnight or 5 GMT, okay, we have a short-term high where we know stops will be residing. A run higher, okay, Judas swing, much in the same vein. This was a Judas swing here, lulling traders into believing it's going to go higher, and into an order block, and pour fib up. If I grab the right tab. Okay, so we have this high here and the low prior to it. Here's the sweet spot inside the optimal trade entry. Okay, here's the 62% retracement level, 79% retracement level right in here. So we have one more example of precision, okay, for London Open. Okay, so we have this set up here. Now, interestingly enough, if you look over here, we have another smaller intraday sell that was available for the New York Open with the same area in mind here. Okay, you see that happening, and they sold it again intraday, only down to a bullish order block here where the trade had to be a collapse because it's too late in the day to see any further continuation. Your stop probably most likely would have been in hit intraday if you would have trailed that. This day here, right in here, okay, we have order block right there. Bullish order block prior to the move lower. We have an area of, let's get this off here. Clean highs, you see that? See how clean that is? Okay, and price running above it. So we have this area right here. So price has to move above where the stops are N has to be in time. So in other words, we have 5 GMT here. We have a rally above time and price, okay, and inside this order block. You see inside that order block. The notion of a reclaimed, okay, or responsored order block. I'll just give you an example of it here because it's staring right in the face. The order block that sent price lower here, okay, see right in here, okay, we returned to this one, but we created another bearish order block right in here, okay. If you look at how we moved right there, right here's your previous order block, again another opportunity in New York session then, and then look what we did here, boom, very precise, okay, very precise, just moving above the midnight time frame. Now the question is this, well, Michael, what time is this move happening? Well, this move here is happening at 5:45 GMT, so it's a little bit early of the London Open kill zone. Okay, my earliest is 6 GMT, so I would have missed the ideal entry here unless I had a pending order. Now I will tell you this, I do get up around 12:30 to quarter to 1, around that time frame, to look for the beginning stages of what should be taking shape, and what I'm explaining here is the beginning foundations of how we're going to be doing intraday trading for London Open, and what it is I look for, how do I frame the ideas about the marketplace and what it should do going into London and at least the Frankfurt Open. So we have this area here, may or may not have gotten a trade, may or not have caught any of this, and the next opportunity, qualifying bullish or bearish order blocks. Okay, moving on over to the next opportunity here, we have the price swing here, moving lower. We have a bullish candle prior to the move lower. Now the reason why I'm using this level here is because it's also the bottom of the body of this candle. So this is an up candle, this is an up candle. Even though we have this wick, the body of the candle here, or the opening of that candle, is essentially that same level. So I'm using that. Okay, and also if you look at the body of this candle as well, and look at the bodies, the wicks of these candles. And this is what we're going to talk about a lot in volume 5, where we start looking at institutional pricing, where they actually do their entries on the institutional level. We have equal highs in here. Okay, what we commonly hear in the retail world is a double top. We don't believe in double tops in the ICT camp. Okay, so we know stops are going to be residing above these highs in here. Okay, and here is midnight time frame, and we would look for a minimum of a move back to that level in here and take out the low of the bullish order block. The bullish candle, which makes the bearish order block. Okay, and that would be our price level that we would be looking to get short on. We also have this range in here that would be viewed as well. We have this price swing down here, and using that as our basis, okay, because this could have been very easily viewed the same way as we're describing here. We have a short-term high right there. So stops would have been resting above this. Price moves above. We are clearly in London Open kill zone here. We do even return back to this previous order block and this order block, and stops are ran, making a higher high here and selling off as a result. This being a 5-minute chart, if you went down to a 1-minute chart, you can actually even fine-tune that even more down to this particular price level right there. That's how we can really refine the risk and increase the reward to risk ratio. Okay, moving on to the next example in here. We have, let me draw back up. Okay, we have price in here really not giving us the return to what I would have liked to seen, at least this bullish order block here, maybe even this one here. Did not do that one here. We did see it return to this one, and let's get rid of these and work with horizontal lines and not be so cumbersome. So we have this bullish candle prior to the move lower. So we are inside that order block here. Price structure is from this high down to this low. Inside optimal trade entry in here. And we did trade against that order block. You know, look at all the candles in here, just the highs of them, just tagging against that price level, and then moving lower. May or may not have been a good early entry, but using the same vein later on in the same day, we had stops that would have been cleared here. That would have been an early entry if it on a limit. In other words, if you had your order already in as a limit order earlier in the morning around 8 and went to bed maybe. If you look at the order block here, bullish candle prior to the move going lower, short-term high, that would be just below, okay, short-term high below the intended order block, that would be bearish. Okay, you see that? And market structure price swing from the high to the low right there. So we have optimal trade entry in here, order block here, stop being taken out here, may or may not have been filled there. You know, fancy dancing around, you know, may not have, maybe not have had an opportunity using that specific entry point. We have a bullish order block here that does reside with the sweet spot in here, which is, I think, is nice. But if you're reaching for that 79% retracement level, which is what you hear me not try to drive too hard, I like to use the sweet spot if I can, but risk permitting, the 62% retracement optimal trade entry level is where I ideally do most of my trades. So again, you can go back through all my other material and you'll hear me say that. It's wonderful, and when I show examples of how the 79% retracement level really encapsulates the high and low of the moves, everyone assumes I'm getting that price. I'm not getting that price. Many times I'm getting this price here, or something in between the 62 and the 70.5 level. I might, you know, try to get creative and look for a level in there, especially if it's a round number. In this case, we have 170.90, which would have been a really good opportunity on this particular day. But my point is this: you see how they're running liquidity into the market by blowing out buy stops, okay, causing the market participants that had stops here to be buying at the market. Well, who's going to take the other side of that market trade? The smart money. They're selling it to them, and they're going to hold that position profitably. All right, let's go back out to a 15-minute time frame. It's getting a little messy looking at this. Okay, we have a short-term high in here, range, order block right there, fell just short of it in here. So no trade early in Frankfurt, and then we have bullish order block right here, intraday, right there. We are now inside of the New York kill zone. Short-term high, range, high to low. This is the market structure price swing that you'd have to use. Parent price swing. Price trades up into optimal trade entry. Right in here is your potential entry for the 1300 GMT time and subsequent price drop. Okay, we have price. I think I'm just going to use a little rectangle. Right in here, stops will be resting above this high. Parent price swing, market structure, high, down to the low. See that price swing here? Equilibrium, right in here, halfway through. So you have a price swing high, down to low, then a measured move from high to low. And let me give you an example of what I'm talking about there. So you can see the symmetry that's in the market. So you have this range from this high down to that low. If you look at the range here, it's almost the same thing. So we have very good market symmetry there. Very good symmetry. Okay, see that? Extend that out. Only had one inherent wick prior to move higher. I only toss that in there because I love seeing it when it happens. It's really really outstanding when you have something like that. It lines up with your understanding of where the market should be going. We have a market structure high here, bullish order block, and the parent price swing is down here, so we would pull our fib on those two price points. Okay, this low to this high. Optimal trade entry is just a little short of the order block. Stops are indeed ran out using this price high right in here with this low as your minimum threshold for order block. Here, there's your bullish order block here. Same scenario with stops above here. Runs into it during London Open. Let's move it over so you can see a little bit better. Yeah, see. Optimal trade entry, again, falling short here. Okay, so we don't have it so much in confluence of optimal trade entry and order block itself, but all the other components are there, which is again, which is kind of like gets back to the notion that you're going to be in a gray area. You may not get all of the things lined up, but you still would have a lot of other factors that would, collectively give you a confluence for the trade. Remember, during this time frame in July, we had already worked the idea out that there's an USDX SMT divergence. In other words, the dollar was unable to make a lower low, and the cable had made a higher high. So we are seeing distribution and accumulation in the dollar, but distribution in the cable. So we are in a sell program. So any rallies after the 12 midnight or 5 GMT time frame, it would be viewed as a Judas swing. Okay, so the optimal trade entry, while it was short of it here, okay, it's short of it here, it doesn't change the fact that you would still be in a profitable position because we're always using a minimum of 30 pip stop loss, going into the market, especially trading London. And just to give you a further view, even if we were using the parent price swing, which is this high to this low, and say you were doing your trade in here based on that assumption, returning back to this order block here, if you were getting short at the 62% retracement level in here, that would be right in here. That would be 170.78. Round that to the nearest round number. You got 170.80. Okay, you're inside the optimal trade entry, and you're also back inside this order block here, bullish candle and it does run out this short-term high prior to it. So it does give you an ideal entry point there inside of London too, because this candle on the high comes in at 8:15 GMT, which is the heart of the London Open kill zone. Okay, and this one here, I'm tempted to go over the mitigation block because there's a lot of examples of it in this section of market data that we're using to teach the principles that were used all throughout this year in 2014. The just know that this low back here will be talked about, and we'll just have to revisit it at that time. But for now, we're just going to say for a moment you didn't know anything about mitigation blocks. Okay, we're going to just assume that for now, and we can see clearly they have a low here, and the market had a nice little turning point in here. Okay, and we also have the bullish candle prior to the move lower, and we also have the body of the candle, this bullish candle as well. So this is a good level. Stops, if I can get this rectangle to work with me, would be just above this short-term high. And let's assume, again, the same thing. We have a high here, move prior to the drop, prior to the rally up, which is right there, this low. So it's this high to this low. This is the range you pull your fib on. This is where you would be entering, okay, right in here. So inside of this area right in here, this is London Open. This would be a good fill. You're also coming back and blowing out the stops here. Now, if your concern is, well, wouldn't I be stopped out there? No. And this is really what I want to kind of get at too. Once you have an understanding, there's 30 pips. Right there's 30 pips. And say you're getting in right at the 62% tracing level, right there. Okay, your stop's up here, way up in here. Okay, and is not ran. So you can see clearly that it did offer some good reward to risk parameters for this particular day. Again, the idea is if you're looking for really, really, really good trade setups, because I'm not trying to teach you to trade every day. I don't trade every day. Okay, but if you're looking for really one good setup a week that really lines up a good level of confluence of events and factors, this is one way that you could arrive at that goal. Now, you don't need to have all of them lined up to get a trade, but the more you have, obviously the more cherry the setup. Okay, but ideally what I want you to learn is that if you are anticipating a selling scenario, okay, you want to see a rally after the 5 GMT, or what we commonly call New York's midnight time frame, the short-term high prior to it, a rally above that, because they're going to take stops out. And once you see that, you'll see the market turn on a dime and go the other way. Short-term high here, the market rallies after 5 GMT, takes a dump. Okay, we start going into a consolidation in here. We're going to assume, say you lost money on this day right in here on the 28th. Well, the same scenario unfolds the very next day. You have a short-term high, we rally up into an existing order block, okay, sell it, boom, power 3. Okay, in here, same thing, just got to look a little bit closer now. Okay, yes, they have a high up here. The move after 5 GMT, okay, trades lower, trades lower, trades lower, trades lower. But then we got to go back and look at what's been going on prior to this move. And we'll talk more about this in volume 5. But right in here, there's something that's very, very influential in terms of price. Okay. And you can see a short-term high here. It gets ran out above this high here into a previous order block right in here. Let me draw that in there because I know some of you are thinking, oh, it ain't there. See that? Boom. High of that candle is 169.40. The low of this candle, 169.40. Okay, so precision, precision, precision. Okay, but again, I know I'm probably driving you nuts by not talking about this, but it's in the next video, guys. Just relax. In fact, we're going to use these same examples, though, if that helps. We have a similar scenario here. We have a short-term high in here with the understanding that we expect lower prices. 5 GMT or midnight, we look for a rally up, take out those stops, returns to a previous order block. Okay, sell it. Boom. Okay. Same scenario here. We have a short-term high in here. Okay, early stops in Frankfurt. They gun it up higher, taking out the stops, returning to previous order block. Boom. Sell it. High probability. Consolidation. Say you lost money. No problem. People lose money sometimes. Same scenario here. Okay. Maybe maybe you didn't have a trade here. Maybe you did or didn't. I don't know. Okay, but let's just say you didn't. I know I didn't trade here because this was the week going into my birthday, and I didn't do anything there. No trade there. Nothing would have been triggered on that. Okay, here's a nice one. We have bullish candle prior to move lower, midnight time frame, short-term high. Okay, notice it only needs a lower high on either side of it. Okay, and once it creates that, stops will build on that because it'll look like this to everyone at the time. That's a bear flag. Everyone's going to say, oh, it's a classic bear flag. Look, it's found some resistance here. Okay, in fact, they'll draw a line, go back to this high here. Okay, and say, well, look, this is clearly resistance. It's in a bear flag formation. It's been dropping, so we're gonna sell it here and put a stop loss right above this price point here. You should be looking at this as a price high, okay, in this order block. And when it gets back up to minimum threshold of 168.54 after midnight, after it guns out these highs, this high, short-term stops, right in here, boom, you're looking to be a seller. Okay, and then the result is profitability. And then that same expected bear flag formation here did eventually materialize, but just wasn't able to pay those participants that were trying to take advantage of it then. Same scenario here, bullish order block prior to move lower. We have a short-term high in place inside of the price swing or range. You have an impulse move higher. Then have a minor little retracement inside of it. Stops will build above this high. They gun it, boom, after midnight. Okay, into the order block, sell it, bang, right there. Lower prices as a result. Okay, you see the repeating theme? By having the higher time frame premise in mind, you'll know what they're going to do and where they're going to inject volatility and liquidity. The liquidity that rests above short-term highs in bearish markets is where they're going to gather up and collect and accumulate new shorts and knock out those participants that would have been profitable. Think about it. If those individuals that were short in here were never knocked out, they'd be profitable down here. You think the banks want that? No. You think the large institutions want that? No. You think your brokers want that? No. Okay, so all of those things are going against you as a trader, so you need to be thinking about that when you're taking your trades. Here's a day that you may have lost money again, and here's another day they say you would have lost money as well. Very next day, we have price moving. Here's a short-term high. Here's midnight time frame. Now look, understand what we're looking at. Okay, we have a low here, and look at the high back here. This is why you want to look at your charts away, like turn your computer on, look at it, sit on the sofa, and have it sit on, maybe a coffee table across the room, and just look at it from a greater distance. Because again, if we start zooming in and only looking at the little minor moves like this, you're going to forget about these parent price swings like this high down to this low. And these are some of the things you need to be doing as you cycle through your time frames. Obviously, everyone has their pet time frames. Mine daily, 4 hour, 1 hour. But this is the price swing that you need to be aware of. This low, that high, back here. If you don't have that in mind, you won't ever see these events, okay? Where after midnight, price runs a short-term high where the stops are, boom. Even in Frankfurt, we have double tops. Everyone calls this stuff in retail world, and it's just like a magnet for everyone to put their stop loss right above it. And you see that happening right in here, boom, on this candle at 9:30 GMT, August 13th, 2014. Boom, right there, okay? That particular day, okay, would have been astronomical in terms of profitability. The parent price swing, you have an order block here. You have a very handsome order block right there, which actually lays right on top of the 79% concentration level, which is really good confluence. With that in mind, that particular level, it looks like it's around 168.42. Is that what that is? Yeah, 168.42. Round it to a round number, 68.40. That should be a good entry, and it's still very close in proximity to the low of that particular bullish candle, which is a bearish order block. So again, we could go on and on and on and on and on and give examples of where it did work and where it didn't, and still be, if you took the positions on a weekly basis, you certainly can find and ferret out some really good and outstanding bullish and bearish order blocks. Now I gave you examples of the bearish side. Everything is the same thing, just on the reverse. You're looking for a swing higher, and when there's a low, you want to see the lows blow out a short-term low where stops would be, and then it would continue higher. So everything you're seeing here on the sell side, just reverse it for the buy side, and that's going to take a little bit of homework on your part, and that's good. It's not all about me giving you cherry-picked hindsight perfect examples. I want you to look at the charts and see for yourselves across numerous pairs of currency pairs. In other words, looking at not just the cable, look at the fiber, look at the Aussie dollar, look at Kiwi, Canadian. It's important that you understand it, and even the dreaded yen. I don't like it, but it works there too. I just don't like that pair. The all these concepts are there for you to be studying and building an ideal framework for how it works in the past and anticipate seeing it in the future. And again, that's where the learning takes place, seeing it unfold real time in your own charts, marking them up in advance, saying, okay, there's a high here, we're in a sell program, they're going to take the stops most likely and return to a previous order block, and at midnight we're going to see that Judas swing move higher, sucking everybody in on the wrong side of the marketplace, and then there you go, you see it taking place right there. And since this is a wonderful example here, I'm going to close this video on this point and encourage you to do your own study. Don't take my word for it. Look at the charts, study it, and when you start seeing these factors build upon one another and you get a greater confluence of things, you'll be able to build a greater trust in the order blocks that you're trading off of. And understand that the 30 pip stop loss is your shield, even though you may have the overall context correct. If you try to trade with too short of a stop, it can still be right in your directional premise, but be taken out nonetheless and not see the profitability that would be available had you used the 30 pip stop. So until then, guys, until we move over to the fifth installment, I wish you good luck and good trading.